Today, we will talk about inherited IRA, definition and tax rules for spouses and non-spouses. An inherited IRA is an account that is opened when an individual inherits an IRA or employer-sponsored retirement plan after the original owner dies. The individual inheriting the individual retirement account may be anyone, a spouse, relative, unrelated party or entity, e.g., estate or trust. Rules on how to handle an inherited IRA differ for spouses and non-spouses. A beneficiary may open an inherited IRA using the proceeds from any type of IRA, including traditional, Roth, rollover, SEP, and simple IRAs. Generally, assets held in the deceased individual's IRA must be transferred into a new inherited IRA in the beneficiary's name. The Internal Revenue Service provides guidelines for inherited IRA beneficiaries. IRS Forms 1099-R and 5498 are required for reporting inherited IRAs and their distributions for tax purposes. Spouses have more flexibility in how to handle an inherited IRA. They can roll over the IRA into their existing individual retirement account or set up a separate inherited IRA account. Spousal heirs also have the ability to defer required minimum distributions of the funds until they reach the age of 73. Non-spouse beneficiaries may not treat an inherited IRA as their own. That is, they may not make additional contributions to the account nor can they transfer inherited funds into their existing IRA account. The Secure Act dictates that, for accounts inherited after December 31, 2019, non-spouse beneficiaries typically must cash out the account within 10 years of the original owner's death. IRA beneficiaries have several options for claiming their inheritance. All beneficiaries have the option to receive a lump sum distribution of the funds or disclaim the inheritance. Spouses have the most options, followed by natural non-spousal beneficiaries. Non-natural beneficiaries have the fewest options. The recipient of an inherited IRA may or may not pay taxes depending on their situation. In general, if you inherit a Roth IRA, you're free of taxes. However, if you inherit a traditional IRA, any amount withdrawn is often subject to taxes. If a child is not yet of age, a custodian may manage the money in the IRA until the child reaches the state's recognized age of adulthood. Then, at that time, the child would have complete access to the funds. They may choose to withdraw funds from the IRA, but depending on the type of account, they may be subject to taxes on withdrawal. It's best for the individual to convert a traditional IRA to a Roth IRA to potentially minimize the tax burden, especially after their passing. In addition, individuals inheriting IRAs can choose to not take non-qualifying distributions that would otherwise be taxable. Many individuals leverage traditional and Roth IRAs to plan for their retirement. Inherited Roth IRAs often have better tax avoidance capabilities, though those inheriting traditional IRAs will be further constrained. Traditional IRAs will have greater RMD requirements. Here are 5 key takeaways. 1. An inherited IRA, also known as a beneficiary IRA, is an account that is opened when an individual inherits an IRA or employer-sponsored retirement plan after the original owner dies. 2. Additional contributions may not be made to an inherited IRA. 3. Rules vary for spousal and non-spousal beneficiaries of inherited IRAs. 4. The Secure Act mandated that non-spousal beneficiaries must empty inherited IRAs within a decade. 5. Traditional IRA owners must now take required minimum distributions starting at age 73, though withdrawal rules are different for Roth IRAs. Hope this would help. Thanks for watching.